Hello, mine Reich Smashers. Welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term Boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And I just had to make a quick video about something that I saw on Meet Breath Kevin's course that really pissed me off. That's right, boy. You crossed the line here. Anyway, overall, it really isn't a bad course. I think it's too expensive, but it's not a bad course. I know some of you are going to be mad at me. Strongman, you're paid off by me, Kevin. Oh my God. Well, guess what? I'm gonna call it how I see it. It's not a bad course. There's some things that I diligently disagree with, like we're going to cover this. But in general, it's a good basic overview of a lot of different stuff. And we'll go through it again when I do my comprehensive review. But at the end of the day, it's not bad. However, this video right here, the harsh reality and danger of the Roth IRA, really kind of infuriated me. You know, we all know Kevin's a real estate investor. I'm not. That's two entirely different things. But I think my advice of putting money in your Roth versus buying real estate is probably a little bit better for the average person. So let's watch this video and learn about the dangers of the Roth IRA.
About the Roth IRA, and I'm just going to...
Oh, I had it on double speed. Sorry. We'll put it at 1.5. 1.5. Okay.
say IRA from here on because that's what we colloquially say, even though technically you don't say IRA because that's a name, whatever. Here's the thing. The nice thing about the Roth is, here's the vision, right? When you're 59 and a half, you have this retirement account that you've built up, and if you desire to take money out of it, you can, tax-free. You're not forced to withdraw anything during your lifetime, in retirement, or at any point. With a normal retirement plan, you're ordinarily forced to take a minimum amount of distributions and pay taxes on those distributions.
Yep, that's a traditional IRA. That's called a required minimum distribution. And it's all based on you take the fair market value of your balance at the end of the year, and you divide that by like a life expectancy factor, and that is your next year's required minimum distribution, which kind of sucks because you don't want to be forced to withdraw the money if you don't need it, but if you have a traditional IRA, you're forced to because the government wants their tax revenue, and you could get a massive tax bill, but that's neither here nor there.
The reason the Roth is so popular is because we see it as this vehicle where we can put money in, grow it by investing it, and then take that money out tax-free. And come on, this entire course we've been talking about ways to minimize taxes. So why do I sound jaded about the Roth? Well, here's why. Let's start with this. Right now, at the time of this recording in 2020, you have a $6,000 maximum contribution that you can make to a Roth IRA, unless you do a conversion, which we'll talk about in a different lecture. So let's analyze this for a moment, okay? Let's say you take this $6,000 deposit. The theory is you put $6,000 into your Roth, it grows tax-free. Now let's say you make $40,000 per year. And by making $40,000 per year with state and local taxes and everything averaged out, let's say you ordinarily pay about 18% in taxes. Okay, so let's do a little bit of quick math here. So you make $40,000 a year at your job. Let's get the whiteboard here. There we go. You make $40,000 a year, and you got to pay taxes on this money that you're going to put into the Roth. So how much of that $40,000 are you going to have to spend to be able to fund your Roth by $6,000? Well, let's figure it out. So you make $40K. And you get taxed at the 18% tax bracket. So how do we do this math? Well, you might remember from the prior lectures, what we're going to do is we're going to say, well, our after-tax expense, this is kind of like when you buy butter, right, is $6,000. Let's go ahead and pull up a calculator here together, and we'll do it together, so that way you can see exactly how I do it, and then that way you'll be able to do this kind of math in the future as well.
See, you even learned some basic division in this course. I mean, is it really that bad?
When you're without Kevin, and you're out in the world of making money and thinking about how to build your wealth, right? So here we go. Ooh. What we're going to do is we're going to take $6,000, and we're going to divide it by 1 minus our tax rate, right? 1 minus our tax rate is 82%. So we're going to divide this by 0.82. There we go. Okay, there we go. So we have to take, of our $40,000 income, we're going to take $7,317. We're going to pay our 18% in taxes, and then that will let us put in $6,000 into our Roth. So that means from our pre-tax income every month, we're putting aside somewhere around $609. Okay, so that just took away about $7,300 of money that we had access to so that we could fund our Roth. So now we put $6,000 into this account. All right.
And remember, once you put that money into the Roth and you let it grow tax-free, you never, ever pay taxes again. So if you have one or two, like Peter Thiel, $5 billion or whatever, you never pay taxes again. It's amazing.
All right, now let's think about that $6,000 a little bit. We put $6,000 in, and we grow it. at, let's say, 5% interest for the next 30 years. Well, if we do a quick compound interest calculation, which you could always just Google compound interest calculator, you put $6,000 in as your present value today, 5% interest at 30 years, that'll turn into roughly $26,000. And heck, there are even special rules that say if you want to take out your original $6,000, you could do that penalty-free with a Roth, which is kind of cool.
You can take out the contributions, but the earnings are a different story before you turn 59 and a half.
Cool, because it's money you already pay taxes on. But that gets more complicated. Let's just stick to this account keeping $26,000 in it. So now it's like, cool, I made $26,000. Well, I made $20,000. I turned my $6,000 into $26,000. It's tax-free. This is great. This seems brilliant. Like, why would I not do that, Kevin? Please enlighten me. If I'm making 40 grand, per year, and I can grow this wealth along in the meantime, and every year add in 6K or maybe a little bit more as tax policies change, why would I not do that? Well, here's why it's dangerous. If you fund your Roth for 2 years in a row, you've taken $12,000 of after-tax money and locked it up into your Roth. But what else could you have done with that $12,000? Well, watch this. If you take $12,000, divide it by 3.5%, you could have bought a house for $342,000.
Okay, here's where the example breaks down. If you make $40,000 a year, you cannot afford a freaking house that's $342,000. Not in the slightest, especially with interest rates going up. And remember this, you can always buy a house at any time. But if you miss a Roth contribution, you can't go back and say, whoa, I didn't contribute in 2018. Can I please do it now? If you miss it, you never do it again. So what he's saying is, and he is correct, if you have this amount of money that you don't put into your Roth, sure, you can go ahead and buy a house. But think about a house. What is a house? Okay, I live in a house right now. I bought this house. Am I making money off this house? Absolutely freaking not. I mean, I know the market went insane, and now my house is like worth 50K more than it was originally. That's very rare. That was pure freaking luck. But if you think about it, when you retire, right? Let's say your house appreciates in value. How do you access that money? Well, you have to sell the house and pay massive transaction costs, closing costs, commissions, fees, all that crap. And then you have to go and take that money and you have to go buy a different house. Now, you may downsize, and that's fine, but as your house has increased in value, so has every other freaking house in your community. So you're not getting this amazing deal where, let's say your house appreciates to 500, 600,000, it's roughly going to match inflation. Versus, putting money into a tax-free account that you can access once you turn 59 and a half. You can take money out whenever you want and never pay taxes out of it again. And he's also assuming you're getting a 5% rate of return, which may be reasonable, but if you really think about it, the market has returned 10% on average. So you're going to have way more than the $50,000 that he's talking about. Buying a house is not an investment. He's biased towards real estate. This house, I hate paying for this house. It has tons of expenses. I have interest. I have taxes. I have maintenance. I can't access the equity in my house without taking out a freaking loan. And if I want to sell the house, I pay massive transaction costs, and I have to go buy another house that's probably appreciated at the same rate that mine has, okay? There's a huge difference between funding your Roth and diversifying, owning every company in the world, and buying one house in one town, in one county, in one city, in one country. It's a totally false comparison. And you cannot afford a house. My house was $250,000, and I made just over 6 figures last year. I'm doing pretty good, but I'm not freaking wealthy. But I can tell you, if you try to buy a house for $342,000 and you make 40 grand a year, you're probably going to get laughed out of the office because you can't freaking afford it. So that's what this example really starts to break down.
And what happens at the end of 30 years? And look, I know the house has a mortgage payment, right? But you have to live somewhere, and you're paying rent somewhere, right? So let's say your mortgage payment with repairs and fix-ups, since you're gonna have to fix up the house over time, your mortgage payment is, I don't know, let's say $1,300. You put aside $200 a month for repairs and fix-ups, so it's $1,500. And let's say your rent would ordinarily be $1,500. So the payment's the same, just to simplify this comparison here. Well, so now I just took 2 years of funding my Roth, which would have turned into, what, $52,000, $55,000 or something like that, right?
Tax-free money for the rest of your life.
26 times 2 plus a little bit. So I could have had tax-free $50,000 to $55,000 growing it at 5% in my Roth, maybe a little bit more if I got a higher, return on my money or whatever. Or I could buy a house, same payment as me renting, so we're ignoring the payment here. Well, what happens after 30 years? You put 3.5% down on this property. What happens after 30 years? You own it because you get a 30-year fixed-rate mortgage. So that means if the real estate market stayed completely flat wherever you bought, you literally now control a $342,000 property for free.
That's true, but think about how much you spent. It costs a fortune to maintain a house, and all the freaking interest and taxes. It's insane. It's not an investment. Now, if you rent it, okay. But if you're just starting out and you're making 40 grand a year, you need to focus on increasing your income. And once you've maxed your Roth, then you can think about saving for a house, okay? That's the answer. You don't want to just sit there and just pile up cash on 40 grand a year. And it's hard to save 6 grand on 40 grand. You don't want to sit there and just save and save and save and save and save year after year and missing all those Roth contributions. That's one of my biggest regrets, is I was a freaking moron and I didn't max my Roth IRA until a couple years ago. I didn't put any money at all because I was like, oh, I already have my thrift savings plan. And now I have all this money in a taxable account. But if I had put that money in there starting at age 22 years old, I would have so much tax-free money right now. It would be ungodly. And the returns that I got were 10% per year, not 5%.
That is, there's no loan on it anymore, right? No, yeah, you got to pay property taxes and things like that, but you own the entire asset. Yeah, you could sell it and probably walk away with like $300,000 after you fix it up a little bit and do some selling costs on that. So now you compare, like, wait, 50-something thousand.
Yeah, you walk away with $300,000, and then you have to go buy another freaking house. You have to live somewhere, right? And houses have appreciated pretty significantly.
Dollars in stocks, maybe 70, 80 if you give yourself a higher rate of return, whatever, or $300,000 or more in real estate. But wait a minute, we forgot to do something. We totally forgot to consider the fact that there is also real estate appreciation, right? Let's do that really quickly. Let's go ahead and pull up the money chip calculator. Let's get rid of that calculator here. And let's just do 30 years. Let's just go with 3%. We did 5% for stocks. Let's go.
So he's assuming you're going to get 2% more buying stocks. Basically, stocks are going to return 2% over the rate of inflation. That seems insanely low to me.
With 3% for real estate. What does your real estate grow at? Well, it grows at the actual purchase price, which we'll just round down and go with $342,000. All right? Oh, that's an $830,000 house now. So you now own an $830,000 house for free. That originally, you'd walk away from that with what, $780,000. And originally you're comparing that to, ooh, I get to turn my $12,000 in a Roth into a tax-free $50,000 to $70,000 or whatever. It doesn't make sense.
But you could also fund your Roth and then buy a house on top of that. That's what I do. It's worked out perfectly. And it's not an investment. I don't know how many times I have to say that.
And see, even if I take this and I go, and we saw 0% was even better in real estate, we go 2%, $619K. Why would you spend your money when, you have a lower income on anything other than controlling real estate? And that's the point here.
Well, another issue is if you have low income and you have a problem with real estate, let's say you have a massive expense after you buy the house, you're sunk because you need a decent cash cushion when you're a homeowner. So if you're low income, it's probably better if you rent until you can actually make enough money and stockpile some cash and be able to afford a home. And that's another opportunity cost. If you have a home, you need more freaking savings because if your HVAC goes out or your freaking roof needs a repair, you're dropping some serious freaking change.
When you're eligible for the Roth, because you're not eligible for the Roth once you make more than $122,000-ish. If you're married, it's a little bit more. But why would you ever?
Well, you can always use the backdoor method, which is another story. You can always contribute to a Roth, and there's ways to do that. And I think in most cases it's probably preferential. The Roth is massive. Like, imagine never paying taxes again. I have hundreds of thousands of dollars locked away in Roth type accounts. And that's probably going to grow to millions by the time I retire. I'm going to have millions of dollars of liquid capital that I can spend on whatever I want in retirement. But, oh, what if I put that into a house? Oh, how am I going to access the money in this house? Well, I have to borrow against it, or I have to sell it. And then, oh, I need to go live somewhere. Crap, I got to go buy another freaking house. No, okay? No.
Invest $500 or $2,000 or $3,000 into the Roth. All you're doing is robbing your ability to own real estate. Now, look.
Would you rather own every company in the world, or would you rather buy one house? Come on, honestly.
Once you have real estate and you're starting to build your wealth, does it maybe make sense to contribute to the Roth? I don't know, because maybe you'd rather contribute to a 401k and take the tax write-offs. So it's like when you qualify to take the Roth, when your taxes are low, you have a massive opportunity cost not investing in real estate. Now, when your taxes go up because you're making more money, you're much more incentivized to put money into a 401k so you can take the tax deduction now because your taxes are higher. So in my opinion, it almost doesn't make sense to bother with the Roth if you're going to buy real estate. Now, look, if you're going to be a tenant forever, that's one thing. I highly encourage you not to do that. There's a reason the New York Times shows that the median net worth of a homeowner is over $196,000 and the net worth of a tenant is around $5,600.
Yeah, because a home, it's like fake wealth. Like, okay, my home is worth probably $300K right now. I don't care. I can't access that money. It means nothing to me. I don't even count my home as part of my net worth. If I did, I'm sure I would have a crazy high net worth, but I don't because I can't access the money.
It's because of this. The government in America says, hey, you want a 30-year fixed rate mortgage where we won't jack your rate up, and if the market falls, don't worry.
jack your rate off.
We're not going to call you up saying you got to pay for it all because now we got 30-year fixed rate loans. Why would you not do that? You need to move, and you turn it into a rental property. And you find something that cash flows, you get a good deal. And look, there's a lot more that goes into it, right? I'm
And a lot of homes you buy do not translate into good rental properties.
oversimplifying the comparison, and I know that. But even when you look at the details, it's like, yeah, but I mean, come on, the numbers are way higher in real estate. But what about...
No. Okay, look, when you're making 40 grand a year, number one, you can't afford a house that he's talking about. Number two, you need to increase your freaking income. So you need to focus on tax advantage accounts, especially when you're not making that much, and avoid the risk of buying a massive expensive property with high taxes, maintenance costs, interest, all of that freaking crap, because you could potentially get sunk massively. So that's my warning. So, I mean, overall, most of the course is okay, and he is pretty accurate on most stuff. I mean, I've seen like minor errors. But when it comes to the Roth IRA thing, I vehemently disagree with him. He's too biased towards real estate. So that's kind of my thoughts. Meat breath. What do you think about that, bruh? Anyway, I'll continue and I'll give my comprehensive review at some point, but I really wanted to highlight this as something that kind of ticked me off a little bit. Anyway, that's it. Talk to you later. Cheers!